What's going on, everyone? It's your boy Nathan here with Win with Nathan. Guys, I shot this video a while ago. Didn't realize I had mute on, so I'm going to redo it. This time I'll keep it quicker. I recently made a post that I have this question come up quite a bit where people want to learn the difference between conventional, DSCR, full doc. Truth of the matter is they're all conventional loans, right, according to the CFPB. But what we see a lot of confusion about is people comparing Fannie Mae to non-qualified mortgage and DSCR. And what you hear a lot of people, including lenders and realtors and coaches, say is that DSCR on average is 0.5% higher than Fannie Mae. Now, that might have been true 5-6 years ago, might have been true 3.5 years ago, but is it true today? Well, in this video, let me tell you what I did. I basically decided to just go to the root, right? So for Fannie Mae loans, I went to 3 lenders, 2 of the largest lenders in the country, and then one, I won't say their name, that's really good too. And I took their best rate on this certain date. Then I took a DSCR loan on that same certain date and matched it exactly to the Fannie Mae. Then I took a third scenario. No, I'm not including full doc or all doc or anything in this, even though there's benefits to it. Then there's a third scenario that is slightly higher than Fannie Mae, but should it be? Do people get this wrong? Well, let's dive into it. So guys, my name's Nathan Gort. I'm here with the lender, Win with Nathan, and I believe that most investors, especially new investors, are getting wrong information.
Wrong, 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 wrong. Wrong, 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 wrong. You're wrong, you're wrong, you're wrong.
I believe a lot of lenders just mislead people. I think realtors do too. And the question is, are they being misled because of lack of information? Is it because they just don't know on the side of like what the lender can do? Or is it simply put, most Fannie Mae loans pay more, right? And that's the truth. So what I did is I went into 3 lenders and went in and got what's called a stripped down par rate. And what I mean by that is when you talk to the 2 largest lenders in the country, they will tell you the average lender paid comp is 2.75. That means it's built in the rate is 2.75. Well, I didn't think it was fair to take that and compare that to DSCR because DSCR rate's going to be a lot cheaper because most DSCR lenders don't charge that much and because most do what's called borrower paid comp. So to make this fair, I wanted to compare a hamburger to a hamburger. So the first hamburger we're going to look at is Fannie Mae. And that hamburger, let's just say it's, who do people like? In-N-Out. In-N-Out just moved to Tennessee. Let's say it's In-N-Out, even though they got a lot of bad reviews right now. So In-N-Out Burger, Fannie Mae, at 20% down, great credit, low debt to income, you're looking at an interest rate of 6.5%. And this is for a investment property. Great credit, no prepayment penalty. You're looking at probably underwriting, the average was $11.95. Most companies have processing. I didn't add that to it. But that's what you're looking at for an investment loan. That's a great deal. And there are times when Fannie Mae is going to be superior to DSCR. But is this one of them? Let's find out. So what I did in option 2 is I compared a DSCR loan. And DSCR, 20% down. On the Fannie Mae loan, I did 2 points origination, right? I'm not charging 2.75. I'm charging 2 points as borrower pay comp. And then with DSCR, I did 2 points origination. I did 6.5%, the exact same rate. And yes, there's a 3-year prepayment penalty at 3%, right? And then, of course, the underwriting fee is $20.95, and there's a doc fee of $5.99. So rates are exactly the same, but the fees are slightly different. Now, you might be saying, well, it's $1,300. Well, of course it's going to be that because you're comparing a In-N-Out fast food burger to going to a restaurant and getting a smash burger, maybe a food truck smash burger that's all the rave right now, and it's still a burger, but this one comes with more flair. This one comes with more benefits, right? It's a little better quality where In-N-Out probably has frozen burger meat, right? That's the comparison. So, and the reason I say that is because when you look at DSCR from a cost point, it's going to be a little higher because it takes more work, right? Smash burgers, the food truck, they have to prepare their food. Every day they get fresh vegetables. You go to In-N-Out or these fast food burger places like Fannie Mae, they already have it all frozen pre-made, right? So yes, DSCR is going to be more expensive because underwriting is truly underwriting, where Fannie Mae, you use what's called desktop underwriter. Everyone does it. It's very simple. It's all automated. non-qualified mortgage and DSCR are coming that way, but right now it takes more details to underwrite. Plus, you're verifying more things with DSCR. You also have the ability to make more exceptions. So underwriting is more expensive. The doc fee has to do with it takes more to process. You also usually are closing in an LLC. There's more legal documentation. So yes, there's going to be an added fee. So from a cost perspective, DSCR is about $1,200 more, $1,200 to $1,500 more in cost. So is that worth it to you to go Fannie Mae and listen to all these people saying that it's cheaper? Well, it might be. So let's talk about the differences. When should you use Fannie Mae? When should you use DSCR? As a licensed professional, not one of these only licensed in DSCR or only licensed to do Fannie Mae, I can look at both loans and tell you the benefits. When you go Fannie Mae, it is great for people who have high income, very low debt to income, and they're going to buy a rental property in an area that maybe doesn't have great comps, right? That maybe doesn't have strong rent, and you want to qualify off of your income, right? Kentucky, a lot of people out there talking about like, hey, we find your properties for you, we do this and all that. They put you in the middle of nowhere and there's no comps for miles. So it's hard for DSCR to get a read on the rental income to qualify. So in that situation, you want to use what's called a full doc loan or a Fannie Mae loan to use your debt to income to qualify. That is a benefit, right? A benefit too that most people believe is that, hey, slightly cheaper. We just said about $1,500 cheaper. That is the benefit to Fannie Mae. Fannie Mae with good income and low debt to income, you pretty much know you're qualified as long as the property appraises because everything is already pre-qualified, right? Now, you can also use what's called market rent. This is a different video, but market rent according to Fannie Mae is long-term rent essentially, right? You can't use short-term rental income. So when I'm comparing these burgers, Fannie Mae to DSCR, I'm comparing long-term to long-term because you can't use short-term rental income to qualify for a Fannie Mae loan projections, right? So that's my third scenario. When we look at a third scenario, DSCR, and we're looking at short-term rental income, yes, that is more expensive. And it should be because it's using something that Fannie Mae can't use, full doc can't use, bank statement loans can't use, is short-term rental projections. There is a cost to doing that, and we don't have to get into why, but it's called a loan level pricing adjustment hit. So on the third scenario, you're looking at 6.75% versus Fannie Mae at 6.5. However, that 6.75 brings you a lender credit of 0.4. So that lender credit of 0.4 on a $320,000 home is offsetting your closing costs. So it's not really that much more. The fact is that doing a short-term rental DSCR loan, you're in between two rates. It's either take a lender credit or do a slight discount. I always go with the lender credit because it pays for the underwriting fee and usually the doc fee and saves you a little money. So that, to me, is where you go to a restaurant like a Texas Roadhouse or burgers, I don't know. Calhoun's, here in Knoxville, Calhoun's, they have great burgers. It's a restaurant style, right? You go sit down at a restaurant, you get prime rib cut back home, char bar. You use prime rib steak to grind up your burger. It's high quality, right? So when you're trying to buy short-term rental and you want to use short-term rental projections, there's a cost to it. There's more experience at those restaurants. The DSCR loans brings better income using short-term rental projections. It's a cost. So again, it's not much more expensive. But now that we know that between Fannie Mae, long-term rental DSCR are almost exactly the same, and then short-term rental is about 0.25 higher in rate, which is minimal difference, right? Now you have to look at the benefits, right? We talked about Fannie Mae is good because you can qualify off of your debt to income alone or your tax returns, and you can do 20% down, 25, whatever, but you're closing in your personal name. DSCR benefit, there's several, but DSCR, the number one benefit most people have is that they want to close in an LLC. They want to vest in an LLC or a trust or a layered LLC. Fannie Mae does not allow you to vest in those. They allow you to close in your personal name, and then you can quit claim if you follow steps correctly. And you might be saying like, well, my loan officer told me that's the same thing. But is it? You need to talk to your CPA and your attorney because they will tell you, I've talked to several, it's not the same thing for liability protection, right? I'm telling you from a lending side, according to Fannie Mae guidelines today, they're not the same either, right? Just because you quit claim to an LLC or a trust, it does not remove that off your debt to income or offset. It will always be on your personal credit. Your debt to income, you just have to show offsetting with tax returns, right? Or leases. Benefit one for DSCR, versus Fannie Mae, it's 1-to-1 now. Other benefit for DSCR that I love. Fannie Mae allows 2% seller concession. DSCR allows up to 9%. So benefit DSCRs, the second benefit is you can include more seller concessions to pay for. I've done prepaid HOAs on a new construction up to 3 years. That's huge. Cash flow. Buy the rate down if you want. Pay all your closing costs, right? So on an average closing cost deal, especially with Fannie Mae charging 2 points to do this as a par, let's just say your average closing cost is going to be between 4 and 5% because you have origination, you have high taxes, prepaids, all that stuff. Well, if Fannie Mae allows you 2%, you're still paying 3. Well, where DSCR allows you 6% on existing, 9 on new, you walk in with only money down, the down payment, right? That means that you're not paying anything to fees. You're paying everything towards equity, towards down payment. Where Fannie Mae, you still got to come out of pocket. So 2-to-1. DSCR, a third option, right? There's several, but a third option that's very popular is being able to partner with people. And what I mean by that is with Fannie Mae, if you want to partner with someone, and they're going to give you money to go into the deal, you have to season that money, right? DSCR, if it's a business relationship, a business account, you don't have to season that money. You can also put them on the LLC and they don't have to be on the loan, right? You can use their assets being part of the LLC. They put their assets in the LLC. It's good, right? So that's 3-1, right? This is not LeBron James versus Golden State, right? Like LeBron James is not going to come back. He's Fannie Mae. Golden State's going to kick his butt, right? Just a little joke there. So DSCR has several advantages. The other advantages with DSCR is simply put, you don't have to worry about debt to income. You don't have to worry about tax return, right? You don't need to worry about that. That's a huge, huge benefit to number 4. Number 5, that's different than Fannie Mae big time, and not many people take advantage of this, is let's say you're partnering with someone and for whatever reason you want to both be on the loan, right? You don't have to because there's no debt to income. But let's say my business partner has a 800 credit score and I have a 520. Fannie Mae is going to deny that loan because of the 520. Over here at DSCR, we're going to approve that loan because as long as one party on the loan qualifies, we go off of that for underwriting. Boom. What are we up to? 5-to-1? Guys, I'm just getting started. As you can see, seasoned investors look at the benefits that come with the loan, right? The newbie loan officers, the newbie realtors, the newbie investors, the people that watch Bigger Pockets, they're going to be sucked in and focus on rate and think rate affects cash flow. But when you look at things from a bigger picture, it's all about the benefits that come with that. A difference of 0.25 in rate, I'm going to take all this list of benefits because of my strategies. I'm not going to go with Fannie Mae to have to worry about tax returns, W-2 jobs, personal buying in my personal name, all that stuff, paying extra fees to quit claim later on, right? I'm going to go with the 0.25 higher. And the main reason for that is, look, it's a rental property. I'm not paying the payment. The tenant is. Or I'm writing it off. So the point of this video is to break the whole myth that DSCR is that much more expensive, right? Now, is it more expensive if you have someone who does a Fannie Mae loan, lender paid comp, versus a correspondence lender on DSCR who puts 3 points in lender paid comp on their rate? Of course, right? When you do correspondence and stuff like that, it's usually lender paid. You hide it in the rate. But when you take it down, strip down, and you look at the rate and you negotiate the origination, the rates are going to be very similar, right? They're not going to be so far off that you're going to want to decide between Fannie and DSCR. You're going to work with a professional, hopefully, someone who is licensed, who can talk to you about all the loans. You know, I know there's a lot of DSCR lenders out there who are not licensed professionals. They will always tell you to go DSCR. They really don't understand lending and they struggle. A lot of them do. Now, there's a few that are good out there, but most struggle. So when you talk with your loan officer and they can compare Fannie Mae to DSCR and you look at the benefits to each one, you will make the decision because you're the investor. You will sit there and make the goal, the strategy, and say, hey, I want to build a rental empire. I'm putting all my properties in an LLC and the cash flow into the LLC because I want to build that LLC up because down the road, I'm going to get unsecured lines of credit. I'm going to get commercial lending. I'm going to do this, right? That's all strategy with banking. So when you look at which loan is best for you, you have to sit there and say, what is best for my strategy? What's best for this? What's best for that? And go with that. Don't let people fool you and say, hey, this is a lower rate, slightly lower cost, let's go that, right? You know, we hear a lot of realtors say, hey, I'm going to put this person as a second home because it's 10% down, but then they really screw themselves. Yes, it benefits you today, same rate as Fannie Mae, but you're paying 10% down, but you're screwed with mortgage insurance. And over the last 6 months, all the people that have called to try to refinance second home loans, they can't because the market stalled, right? So you have to know what your strategy is, what your goals, what your exit strategy, and go with it. Now, Fannie Mae's pro is that they don't have a prepayment penalty, right? DSCR technically doesn't have a prepayment penalty, but it costs more, right? That's where seller concessions come in too. You can buy out the prepayment penalty. Fannie Mae doesn't have a prepayment penalty because it's backed by government entities, right? It's in conservatorship. Investors want to make sure they get their money back, at least break even and a little profit, so there's a prepayment penalty. So if I did a 5-year prepayment penalty, guess what? The rates are cheaper than Fannie Mae. But most people do a 3-year 5%. I did in this scenario a 3-year 3%, and we're still competitive with Fannie Mae. So the point to this is, yes, Fannie Mae has the benefit of no prepayment penalties. So yes, they do have a score of 2. Yes, they have the benefit of you can go buy in middle Kentucky like a lot of STR experts are telling people to buy, but there's no comps within 100 miles. And you can qualify using your debt to income. Yes, you can do that. But every other benefit when investing in real estate, it kind of leans towards DSCR. So again, I'm not telling you which one is better. I'm just telling you that when you work with a licensed professional, we're going to sit down and talk. We're going to discuss your strategy and figure out which one works best for you. So before you get fooled by these Facebook posts, these videos, and all these myths by masterminds and coaches, just realize the cost is not that much different. And a lot of the millionaires and billionaires out there, they are not focused on rate, guys. A lot of them use private money. They use defer payments for private money. They do a lot of things because they realize interest rate doesn't matter, right? It helps me on my taxes for write-offs. The tenants are paying and all that stuff. What they see is they see what can get them into property the quickest, the easiest, according to their goals, strategy, asset protection, wealth preservation, and they keep moving. So guys, if you have had a loan officer tell you Fannie Mae is superior, so much cheaper, anything like this, give me a call. Let's have a talk. Let's sit down and work on your strategy and your plan to see which works best for you. Again, my name's Nathan. I'm with The Lender. I look forward to hearing from you. Call me anytime. Have a good one.